Welcome back. It's the last trading day of the year and Happy New Year to all of you in advance. Market expert Anand Tandon joins in now to reflect upon the year gone by and tell us how he's approaching the new one. Anand, good morning and greetings of the season to you. It's been, we were just reflecting upon how India has seen a huge outperformance and not just the headline index, but if you look at certain pockets, the Nifty Metal Index, the Nifty Bank, all up over 20% in the year gone by. What do you see as the big trend in 2023?
Well, Sonia, first of all, season's greetings to you and all your viewers, and Happy New Year. The market has definitely outperformed, and the outperformance has been stark, both in terms of actually even the corporate performance as well as the markets, relative as well as at absolute terms. The next year, obviously, will be a little more challenging. I mean, the number of headwinds that you are aware of already and a lot of people have commented on continues. And I think the biggest challenge that we will continue to see will remain the interest rates. I think the fact that the US may pause in the second quarter or thereabouts is something that is being already assumed by the market, and anything that happens which extends the time frame is going to be a bit of a shock. More importantly, I think the thing is that the market's already assumed that not only will it pause, it will start to have an immediate cut. And that, I think, is where the disconnect is. Because I don't see a cut happening anytime, very quickly, immediately after that, because I think you will continue to find that you need to reinforce the fact that the Fed is willing to take action. And based on that, I think, the challenge for equity is that with yields in debt becoming fairly attractive, overall, it is going to be a lot less attractive to be investing in equities in relative terms. And as a consequence, you may actually find that some amount of money gets shifted into debt, which is perhaps at this stage an under-owned asset class, as it were, within India. From a market perspective, I'm not taking into account fixed deposits, etc. People who don't invest. But among those who invest, I think most people have increased their stake fairly significantly in equities.
All right, Anand, morning. So just a quick word on some of the sort of movers that we saw yesterday. You got names like Nykaa, which moved up sharply. These are relatively newer listings, right? Nykaa not so much, but it's a year and a half old. There's Bikaji, which went up quite sharply. I think Inox Green was up some 9-10%. Any thoughts? Do you track any of these?
Well, Prashant, I think, today and yesterday's moves are more to do with the fact that we are ending the quarter. So I wouldn't read too much into that. But if you look at it thematically, certainly the only bet that one is taking is in the domestic side. Exports are likely to not do as much as expected. And therefore, most portfolios are now structured towards the domestic side, with clearly banking being the first. But now increasingly, the assumption is that, rural India will do better than, at least for this year for sure. How much better is a matter of conjecture. But, the sowing season has been fairly decent. Incomes are somewhat going up finally in the rural markets. And therefore, things like, FMCG, etc., FMCG or even any other consumer discretionary aimed at the rural side, two-wheelers, for example, would actually do reasonably well. So I guess the portfolios will shift accordingly.
So your case is that this year perhaps could be that of rural recovery. Anand, what are the other themes that you're watching out for? The last year, we did see a lot of the value themes do extremely well. PSU banks, the valuation differential between private banks and PSU banks. We did see a lot of the indigenization themes do extremely well. So defense was one of them. What do you think could be the themes of 2023?
Well, I think when you call it value, it is value only in the sense that you are getting growth now. So the assumption is that, the balance sheets of public sector banks have got cleaned up, and therefore you will see growth. So I would argue that it's not really value investing that you saw. You just saw a change in the sectors that you are going to see growth in. So defense, for example, for the longest time has held out promise. But last year you actually had order books coming through, and the government actually is putting in a lot of money there, which then increases the visibility of growth, and therefore, the stocks have done exceedingly well. So as I said, I think if you look at where the growth is likely to be, I think from the sectors that have done well, banking, I think, will continue for at least another couple of quarters, especially corporate-facing banks. Defense more or less looks like it's actually peaked out quite a bit, because from here, the incremental order flow will only make the pipeline better. It's not going to change earnings anytime in the next 2-3 years. If you're looking at FMCG, as I said, you'll probably see a slight uptick there. If you are looking at, for example, two-wheelers and tractors, perhaps there is an expectation that volume growth will come back there. So essentially, those are the kind of sectors that one is looking to position in.
Okay, all right. Well, Anand, stay on. It is the end of the year, so we decided to